Thank you very much. Good evening, everyone. So I'm going to talk to you about the Standard Life Investments Property Income Trust. It's a company which is structured as a REIT, a UK REIT for tax efficiency. And actually it's quite simple. It invests in property to give a good income. So the title is sort of the trust is very much a guide to what we do. And actually it is what we do totally. We focus on income. We have a very simple objective. I'm going to have to add another line, I guess, to the objective now of about increasing the shareholder base or something. But at the moment, it's very simple. It's an attractive level of income with the prospect of income and capital growth. I was slightly nervous, actually, as Tom was speaking earlier, that I was really proud about my 5.1% dividend yield. I think that's quite a sustainable yield. I'm going to say that up front to start with. And why do I think it's quite sustainable? Well, investing in real estate, so commercial property, we let it out to tenants. I've got 60 properties let to 223 tenants who pay their rent to me. Well, not to me, but to the company. And we collect it ourselves. We collect 100% of it within the time that the tenants get to pay. And they pay it quarterly in advance. Now, that rent isn't like a dividend. They can't say, actually, we don't really want to pay it this, we're going to shorten cash. It's not like anything else. It's a contractual arrangement. And occasionally people think that they're not going to pay it on time, but my colleague Jerry phones them up. And then they pay. And occasionally we found that one or two people, particularly on a big industrial estate, they think they can take advantage of us. And once they've had the bailiff come in, they get quite embarrassed. And actually their neighbours then are quite embarrassed as well, so they pay on time just to avoid it. So having Jerry is very useful. We do have a covered dividend policy. So going back to one of the comments Tom made about sort of over-distributing. And up until the beginning of this year, I could proudly say that we have a covered dividend policy and I've adhered to it. I haven't so far this year. That isn't a sign of concern for me because it's for a particular reason, and that is we sold some assets and we're sitting on cash. And I'd much prefer to stand here and tell you my dividend is uncovered and will be uncovered this year, but I'm going to buy some cracking assets, than rush out in January and tell you I've got a covered dividend, but I bought some awful property. So we're reinvesting at the moment, and in fact there should be an RNS going out in the next couple of days about some purchases we're just completing, which is going to move us back towards being covered again. But we won't be for this year. It's taken me slightly longer to find the assets which have excited me, and I like to be excited if I'm going to buy something. I'm just going to mention debt as well. We do have some debt in the structure. The LTV, we published it at 14% at the end of the quarter. That's probably a misleading figure. It's really sort of 20% because once we reinvest the cash we've got, it goes from sort of coming off the top line of the calculation. So I'd say our debt is roughly 20%, and we pay 2.7% on our debt, and obviously our yield on the portfolio is just under 6%, so it's quite accretive, quite attractive. But we want to keep it at moderate levels at the moment. I think as we've got a more certain outlook, we might increase up to about 30%. But the days of sort of 65, 70% are long gone for me. I'm aging too fast for that. Learned something in the last downturn. Now, I have the honour of standing up here and talking to you about the trust. I consider the trust to be my baby. I love it to bits. But you'll be really relieved to know I'm not the only person looking after it, and there's actually quite a large team. I've got some fantastic asset managers who I require them to go and visit our properties and meet our tenants. I don't believe that we should send in an agent to go and see our properties. We should build that relationship. And I think as landlords, we have to learn to change our ways from being that remote, awful person who just demands rent to someone who can provide a bit more service. So I've got a great team of asset managers who can focus on the assets. I can focus on some strategy because we've also got lots of support from around us. So tax and accounting and reporting, debt, development expertise, I can call on it all, which I quite enjoy. So one of the things about buying into a fund rather than perhaps going out and buying a shop in the high street, which individuals may have done in the past, is diversification. So as I mentioned earlier, I've got sort of 60 assets, 223 tenants. And a lot of that's allocated to industrial. And there's some very simple reasons for that. I don't like or understand retail. It is, I think, in terminal decline in many respects. Industrial is much simpler, and that suits me. I can walk into a shed, and I know, does that shed work? Is the yard big enough? Can the lorry reverse up to it without scraping its wheels? Are there enough doors? Is the floor strong enough? Yeah. Good old test, you know. And I can work out, am I going to find another tenant for that shed? Is it in the right location? And so I like sheds. And for industrial, please now read logistics. We're just not quite modern enough in real estate to have got to logistics instead of still calling it industrial. We don't actually have much industry in it, I'm afraid. Although I am just buying an aluminium smelting factory doing some really high-tech moulding, which is so exciting to see a British industry winning global contracts because they can do things that no one else can. I've got a very low weight to retail because the high street is suffering so much and retailers are suffering. I'm not a great fan of CVAs, you'll be surprised to hear. I'm delighted to say that I actually haven't had any CVAs in the portfolio. And I must be honest now and say that's partly because two of my tenants bypassed the CVA and went straight to administration. I had a small Maplin. I'm pleased to say we've got the unit, some interest in the unit, and a Pound World where they're still trading, they're still paying rent, and actually we've got B&M and Pound Land wanting to take the unit. B&M I'd be happy with. Pound Land I think will come shortly after Pound World. So it's a tricky market and one which I don't want to have too much exposure to. Offices are changing as well. The way we work is changing. Now, I look around the room, and I've better be careful not to be too rude, but some of us are getting on a little bit, and we're used to commuting. The millennials don't like commuting. Apparently, it's not a cool thing to do. They prefer to fall out of bed at 10 in the morning and still turn up at the office on time. So the way people work, where they live and work, the environment they want. I don't know, when you came in here, did you notice all that breakout area of cafes and seating and a big TV to watch the tennis? That type of vision is essential if people can retain and recruit the right staff. I want to make it easy for my tenants, so I make sure I've got the assets which can do that. And quickly on region, just as if I'm going to upset people about their age, I may as well, I don't invest much in Wales, so sorry if that offends anyone. And actually, although I've lived in Scotland for the last 21 years, I don't invest much in Scotland. I've got a little bit, and I'm just buying a logistics unit on the motorway into Scotland on the basis that people have to go in and out, and that would be a good spot. But I like to concentrate a bit more on the southeast. Just the concentration of wonderful people is a reason for investing there. Now, I've talked about assets. I think at the moment I can talk to you about industrial's good, retail's poor, bad, etc. Actually, it's about the asset. You've got to have an asset which works, and tenants who want to be in there so that they pay you your rent. And so we take a really active approach. We go and visit our tenants, our properties. We make sure that they're fit for purpose. One of the things which annoys me is it used to be considered the right thing to do just to buy a property and then do nothing. Don't go to it, just collect the rent, and at the end of 15 years, spend some more money on it. Actually, we've got to go in there, we've got to make sure it works, alter it, make it relevant for tenants, and then they'll stay and they'll occupy. So my philosophy is, I want assets which are good quality and a good location at a good tenants. I don't really mind about lease length, because if you treat people right, they'll stay. Moving, has anyone moved house recently? Awful, isn't it? It's expensive. Hugely expensive. It's time consuming, it's distracting. People will stay if you provide them with the right accommodation. The reason I've talked about sales, and my colleague was saying you can't put in sales because anyone who wants to buy the shares isn't interested in what you sold. But the reason for putting it in is it's about philosophy. So I'm quite happy to take profit. one of the things I learned in the last downturn is I can stand up here and tell you how wonderful I'm creating value for you all as my valuations go up. And then when the market turns, the valuations go down, I have to find another tune. So I do realise profit occasionally, particularly where I can do it and reduce risk. So these were two assets where there was potential for void and large capex. And if you run an income fund, you really don't want voids because they cost you money and no one's giving you rent. And so this was just two examples of where we decided to exit at a profit. But we've reinvested some of the money and a few more deals to come through. Now, Bracknell is somewhere where I would not have invested 15 months ago. Bracknell, and I'm going to upset probably more people, been an awful place for quite a long time. The town centre has unfortunately it was a concrete jungle, it was horrible. Tenants would phone up agents and say, any way we can get out of Bracknell. But L&G and Schroders have invested a fortune over the last few years and just rejuvenated the town centre immeasurably. So it's actually got nice retail, restaurants. There's been public realm works just outside this office, which is just by the train station, with great car parking. It's been refurbished. It's let to a variety of different tenants. There's a void on the top floor, which I've got some interest in. So we bought back into there. I love to buy places where someone else has spent a lot of money improving the infrastructure. So that seemed like something which excited me. I wasn't convinced by the yellow, I have to say, on the entrance, but we can change that in time. And then I bought a couple of industrials as well. So Shellingford, I must confess, I had to look up where it was. It's between Oxford and Swindon, main road going down between them. What I liked about this was when I went round, the occupier's been on site for ages. They've invested massively. And it's a sale and lease back. And I said, so why are you here? And they said, well, if we go 15 miles up the road, the rent nearly doubles. It's just over a third more. And our labour goes up by £1 an hour. We don't need to be just 15 miles up the road. This location works for us. And it's trying to understand how that works. I think labour is going to be a major, major factor, particularly in the industrial sector, with some of the constraints which might be coming forward, who knows, over the next couple of years, but labour is already an issue. And then, so Aintree, I don't actually like horse racing, but this is right next to the race course. I've got a Premier Inn, a Toby Carvery, a gym, and a KFC. So it fits the local demographic quite well. The Premier Inn is at the bottom end of their range, and actually we're doing a deal to take them out and put the Mitchells and Butler will take a longer lease on it and pay more rent. So we knew there were some asset management angles there which the previous owner hadn't really exploited. And then my softer side, I bought some flour processing in Sandy, Bedfordshire. And again, this was, actually the tenant's not particularly good, but he's been trading there for the last 65 years. It was a family company. And the old boy, if I can call him that, who opened up the place originally, actually lives next door to it still. So it's quite nice to chat to him about the changes. But this is on the A1, dual carriageway, right on a junction, which is a huge junction. It serves just about nothing else. 35 miles north of London. I could knock the buildings down and let the land for hard standing and get the same income. Because they're quite grotty units. It's on a low rent to suit the tenant. So for me, it's close to being a no-brainer if there is such a thing in the investment world. I just quite like the idea that I could buy something which is future-proofed really in value. And I just think income's going to grow because so many people are being displaced out of the M25 where land values are getting really, really expensive and rent's very high. So there's an idea of some of the things we've been doing and creating some value. Now, the other thing Tom said earlier, and in his first opening words, were past performance isn't a guide to the future. And I mean, I have to say that's something which worries me most of the time. The past performance has been okay. Do I think I could deliver an annualized return over the next 5 years of over 16 or 17 and a bit %? No, I don't think I can. We've had a great 5 years. Do I think we can still continue to perform quite well? Yes, I do, and there's a variety of factors. One is I really like the properties I own. and I like the tenants I've let them to. You know, we're in a good place, and we can actively manage them. So I'm relatively optimistic that we're in a goodish place. So to pull it all together, as I've rushed through sort of the trust and what we've been doing, every property manager will tell you they're active. I'm just slightly more active. Okay, just remember that I'm slightly more. They'll all tell you they're active. We like to differentiate ourselves a little bit by trying to buy something which no one else wants to buy today, but we think they're going to want to buy tomorrow. So being the early investor back into Bracknell. And actually, when I was offered it, I said to the guy, "You must be kidding. I'm not going to buy in Bracknell. It's awful." And he said, "Baggers, trust me, come and see it. Come back down. When were you last there?" And it reminds me about how important it is to get out and see places. So we are quite active. I travel around a lot. We're a REIT. What does that mean? We're an investment company. We talked a bit earlier about being open-ended versus closed-ended. Every decision I make, I can hand on heart say, I make it in what I think is the best interest of shareholders. Now, some of them will turn out to be pretty poor decisions, and I've got them wrong. You know, that happens. But at least I had a good intent. If you run an open-ended fund, you do have to deal with cash. Cash to meet redemptions. So you have to sell some of your best assets when you don't want to sell them, or you've got a wall of money coming in when you don't really want to invest, and you've got to invest. So it's a great structure for an illiquid asset like real estate. As I said, I think we've got quite a good outlook. We've got a low exposure to the weaker markets, so we should have a good following wind. And we've got some quite encouraging sort of lettings going on, which are moving rents forward a bit, so quite positive. I've mentioned the dividend already, and I thought I was happy to take questions, but I'm not until the panel session. So at the panel session or afterwards, I'll be delighted to. And that is me 4 minutes early, which is unusual. Thank you.